A new era is upon us. Tangent PropTech unites founders, real estate and VC investors, urban leaders, and passionate creators who are improving our communities and cities. Join venture capitalists Jeffrey Berman and Zach Aarons and PropTech entrepreneur Edward Cohen, that's me, to learn about housing innovation, the future of work, and climate tech. We examine these themes through interviews and conversations with PropTech CEOs, real estate owners and operators, and venture investors, and how we can leverage tech and collaboration to help solve the housing crisis, figure out the future of work, and how to decarbonize the built environment. If you would like to get your company's or organization's mission featured on Tangent, email us at tangentcommunity@gmail.com. Hi, I'm Edward Cohen. Welcome to Tangent.
Hey there, Jeffrey Berman. Tangent. We're going to get somewhere today.
I'm Zach Aarons, Jeffrey Berman's trainer, physio, and therapist, all wrapped into one.
Today on Tangent, we have Austin Allison, CEO and co-founder of Pacaso. Hi, Austin. Where does this podcast find you?
Hey, Edward. Thanks for having me. I'm actually in Lake Tahoe today in Northern California. It's great to be back.
Beautiful. Is that one of your markets as well in Pacaso?
It is. Yeah, it was actually one of our first, I think it was our second ever Pacaso market. Our first market was Napa Valley. I live in the San Francisco Bay Area, so it was natural for us to start in Northern California.
That's great. I mean, just because you're bringing up, your early beginnings. In your first 4 years, Pacaso has facilitated over $1 billion in transactions of second homes, brought on 1,500 homeowners, and generated over $100 million in gross profits. Not too shabby. But I want to ask you, how has the housing and PropTech market, particularly in the second homes in the cities that you operate, shifted since September 3rd, 2021, which is actually the last time you were on Tangent?
Well, it has shifted quite a bit. Even before September 3rd of 2021, I think it's worth mentioning what happened in 2020 and 2021 leading up to that time. After COVID gave everybody, not everybody, I guess, but most people more flexibility and an opportunity to kind of rethink how and where they live and work, we saw an incredible surge in demand for second homes following COVID. And that really described most of what we experienced in 2020 and 2021, all the way through the first half of 2022. But by the end of 2022, a lot had changed in the real estate market. And the biggest of those changes was interest rates. Interest rates roughly 3x'd in a pretty short period of time. During the heyday of 2021, you could get a mortgage I've in fact run into people who got mortgages that started with a 1%. So there were mortgages available at less than 2%, but it was not uncommon at all to get mortgages in the low to mid 2% range. And when they shot up to 8% plus, that really brought the housing market to a screeching halt because consumers were in shock, if you will, with respect to this new interest rate environment. We were so accustomed to the low rates for so long that it was a big adjustment for people to get their minds around 8% rates. And then the other practical challenge associated with a big interest rate increase is that it influences affordability. So someone who could previously afford a home that was valued at X with a 2% mortgage can no longer afford a home valued at X with an 8% mortgage. So that really created a pretty challenging real estate market in 2023. Some people describe the 2023 market as being worse than what we experienced in 2008. Certainly, if you adjust for time and population growth and all the things that have happened since 2008, the numbers would suggest that 2023 was a more challenging market than 2008. But all that really started sort of changing throughout 2024. And I think the big change that I noticed was consumers adjusting to the new interest rate reality. They went from being in shock, with respect to 7 and 8% mortgages to just accepting that this is probably the new reality, at least for a while, meaning we're not going to see 2 and 3% rates anytime soon. And then when the Fed started lowering rates again, that was the next big thing that I think helped a lot because it signaled to the market we likely saw the worst of it, meaning we can kind of count on, where we're at now is in the sixes roughly. And I think we can expect to be in this range, plus or minus, likely minus 1% from where we're at today. So people are settling into the new interest rate reality. Transactions are picking back up. And we're certainly experiencing a lot of that growth in the vacation home co-ownership space in particular.
That's true. Fascinating ride it's been in the housing and co-ownership world. I mean, the US market for co-ownership grew 21% year over year. But curious to hear Jeff and Zach, this Pacaso's rise, besides having immaculate timing when they launched, it has coincided with the rise of fractional ownership and co-investing models. What are your thoughts not only on, the rise of co-ownership in second homes, but also the broad PropTech space launching, fractional and democratizing access to investments?
Yeah, I can start. I think it's a natural evolution for the space. I think fractionalizing things like vacation properties without everybody online, everybody having connected financial technology, banking applications, it would have been too challenging, too much paperwork, too much administrative burden, right? Had we launched a platform like that 10, 15 years ago, you've now seen the proliferation of financial technology directly into the consumer's homes, coupled with more comfort around leveraging technology to share real estate assets, to service them, to manage them. So a lot of the technology and service businesses that Jeff and I have been investing in for the better part of over a decade enable not just the fractionalization of properties, but the fintech components that underlie the transaction efficacy, and then also the management capabilities of those properties, right? So I think we're in a moment where people are embracing these types of technologies. They want to have a different way to vacation. And they're also, it's not just vacation homes that are getting fractionalized. We're seeing it across the spectrum, whether it's SFR investment properties or other types of real estate assets. Syndication's been around for a long time. We did a case in business school on the Gray Bar building, which was syndicated in the 1950s. Shares were sold off to a bunch of doctors and lawyers. But I think you're really seeing it now in this decade start to penetrate to Main Street economy. And if you talk to people all over the country, there's a much greater amount of comfort with holding assets like this than there would have been 10, 15, 20 years ago.
Yeah, if I could just chime onto that for a second, Edward, I agree with everything that Zach said. Really, really well put. There's one other thing that I think is at play here that's really providing a tailwind for fractionalization and co-ownership of various assets, and it's affordability. This is certainly the case with housing. Housing is not very affordable today. The problem's only getting worse, not getting better. And fractionalizing or sharing ownership and things enables people to, afford more than they would have otherwise been able to afford alone. Take Bitcoin, for example. Not everybody can afford $100,000 Bitcoin, but thanks to, various platforms, you can buy a fraction of a Bitcoin and get access to that asset class. So I think that is certainly going to continue to be a driver for co-ownership in the housing space, because it's just a more affordable and responsible way to own an asset that was previously out of reach for many.
Support for this episode comes from Pacaso. Pacaso is transforming the $1.3 trillion vacation home market. Their innovative marketplace makes buying, co-owning, and even reselling luxury homes seamless. Here's the reality. 75% of Americans dream of owning a vacation home, and 40% want one within the next year. Pacaso is redefining luxury vacation home ownership and capturing this huge demand by making it easier than ever before. And now, for the first time, they're opening the door to a unique investment opportunity for accredited and non-accredited investors who can purchase stock in Pacaso through their latest growth round. That means you can join their cap table alongside top-tier investors like SoftBank, Mavron, Greycroft, and Fifth Wall. With over $100 million in gross profits and more than 1,500 happy homeowners, Pacaso has already established itself as the market leader. Now you have the chance to own a piece of this high-growth company built on a strong foundation of a vibrant community of co-owners and housing industry leaders. If you want to be part of reshaping the vacation home market alongside top-tier investors and the former CEO, co-founder, and executives of Zillow, visit pacaso.com/invest. That's pacaso.com/invest. Pacaso, making luxury vacation home ownership accessible for everyone. Disclaimer. Investments in Regulation A offerings are speculative, involve substantial risks, and are not suitable for all investors. Read the offering circular at pacaso.com/invest before investing. Past performance is no guarantee of future results. Please consult your financial advisor before making any investment decisions. The US vacation home market, $1.3 trillion industry. Something that was, I think, impressive reading into your recent performance was how the properties you co-own have appreciated nearly 10% since 2021, which far outpaces the broader luxury market of just under 5%.
How do you guys measure that increase?
We conducted a study where we looked at how our shares performed in the secondary market, and then we compared that to the whole home transaction data in the same markets. And we did see an outperformance by a factor of more than 2x. The same whole homes in the markets that we studied averaged about 5% appreciation in the period, where our shares averaged 10. And I think we expected that our shares would track the underlying real estate, because at the end of the day, you're buying real estate when you buy a Pacaso. You just happen to be buying the house with a small group of other people. So it makes sense that the underlying asset value would track. But I didn't necessarily expect that it would outperform. And I think one of the reasons why we're seeing some of that outperformance is, first and foremost, I think there's just more people who can afford or justify owning 1/8 of a vacation home than the number of people who can afford or justify owning 100% of something that they're only going to use 10% of the time. And then I think the other thing that's at play is, in addition to making the real estate more affordable, we're also making it more hassle-free. Because if you buy a whole vacation home on your own, it's a lot of work to manage the property. Like where I'm sitting today in Lake Tahoe, in a big year, we'll get 60 feet of snow. I mean, the snow is so heavy that it literally collapses roofs if you don't plow your roof. And that's just one example of many things that makes it difficult to manage a vacation home. And we've made it really easy. So I think if you look across other industries that have leveraged fractional or co-ownership concepts, it's not uncommon to see a premium that is earned through the fractional offering. Like NetJets is a good example of this in the aviation space. They have a very similar model to Pacaso. They sell 1/8 interest in jets, and it's actually significantly more expensive per hour to own and fly through NetJets than it would be to own and fly your own plane. But people pay a big premium because NetJets has provided an elevated experience. They have, a bigger fleet, which means more availability. You're able to move up and down into different types of planes, better service, better pilots, better fleet. There are just certain advantages to a managed experience like this that you don't get the benefit of if you own a whole home on your own.
So can we talk about the difference between, and this kind of dovetails into the Reg A offering, which was that already done?
No, it's actually live right now. We just launched the offering 30 to 45 days ago. So basically, I'll provide a quick 30-second background on this. When private companies, and you guys may know all this is really for the listeners. When private companies raise money, they typically raise through a regulation called Regulation D. And so if you were to go raise from an institutional, investor or venture capital firm, it's done through Regulation D. Regulation D, for all intents and purposes, limits your ability to raise from only accredited investors. You're not allowed to raise from retail investors through Reg D. You're also not allowed to advertise the offering to the public. So that's Reg D. There's another reg called Reg CF, which is the crowdfunding regulation, which enables companies to raise up to $5 million per year. And it's got lighter weight, SEC disclosure and kind of compliance requirements when compared to Regulation A, which I'll get to in a second. And most companies who use crowdfunding are doing it through platforms like Kickstarter. There's this other reg called Regulation A, which has been around for a long time, but it wasn't really made mainstream until it was reformed as part of the Jobs Act in 2015. And the reason why it was reformed as part of the Jobs Act was to democratize access to exciting private companies so that retail investors could invest in them and participate in the growth. So that when we learned about Reg A, we really sort of resonated with what Reg A is and what it stands for, because core to our mission and business model is democratizing access to, in our case, the asset class of vacation homes. But Reg A is a way to democratize access to the company. And over the years, we've had customers and prospective customers ask if they could invest in Pacaso, the company, not just Pacaso managed real estate. And Reg A is a platform that has enabled us to do that. So we're really excited about it. The offering is open right now, and we're cleared to raise up to $75 million through this Reg A offering.
And how long are you allowed to keep that Reg A offering open?
12 months. So we can close it before 12 months, or if we get all the way to the 12-month period, we would be forced to close it at that moment in time.
Got it. So put that aside for a second, because one of the things that I've been thinking about, and to the point that Zach was making, is how do you convey to people from the both, and I suppose it doesn't matter from the experience side, but from the investment side, how this is different than a timeshare operator where you're buying X amount of blocks of time per annum. And correct me if I'm wrong, because I'm not overly familiar with the company, but you mentioned something really interesting, that shares were sold on secondary. And I'm really curious about that, whether that is a differentiation point from the timeshare, and then from the investment perspective. How do you guys think through that?
It's a great question, and I'll explain the difference. Before I do, I just want to say, I'm going to explain the differences, but by no means am I, intending to bash timeshares. I think there is a time and a place for a timeshare, and I've met a lot of people who own timeshares that have had great experiences. So I'll just explain kind of the factual differences. The first big difference is what you actually own. So with a timeshare, when most people hear timeshare, what they're thinking about are the hotel timeshares, whereby they're typically sold in 1 week intervals, and you're prepaying for the right to use a hotel room in a particular project. So let's say like the Marriott Vacation Club, as an example, is one of the leading timeshare companies. If you were to buy a 1 week timeshare with the Marriott Vacation Club, you're going to buy a specific week in a specific hotel, and then you have the ability to effectively exchange that week with other timeshares in that portfolio. You are typically one of thousands of people who purchased weeks in that property. So like, let's say it's a 300-room hotel. Each hotel room is split into 52 weeks. 300 times 52 is 15,000 units that are available for sale in a single property. So there is an abundance of supply with the timeshare model. With the Pacaso model, you're not buying time in a hotel. You are actually buying a house with a small group of people. Each house is unique. Each house is only divided into 8 ownership interests. So at absolute most, the most units that would ever be available in a particular home are 8. And normally there are fewer than 8 owners because some people will buy more than 1/8. So typically you'll see like 6 owners or something in a Pacaso home. That difference in the asset that you're buying really has a lot to do with how that asset retains value over time. So with timeshares, one of the reasons why timeshares get a bad rap is because people get stuck in the timeshare and they're unable to sell. And if they do sell, the industry average, last time I looked at this data, is that you sell for less than half of what you paid. With Pacaso, you're buying real estate. So as long as it's good real estate that's trending up in value over time, your asset is going to go up in value over time. And I think the resale data that we just spoke about a moment ago is great evidence of that. The one other thing that you could argue is you could argue that with a timeshare, you're kind of buying a liability in the sense that you're sort of signing up to pay for this hotel room into perpetuity. again, whereas Pacaso, you're buying a real estate asset. And the test that I like to use for that is kind of a hypothetical scenario. If the Marriott Vacation Club went out of business, which Marriott is a great company, they're not going out of business, to be clear, like they're a great legitimate company. But if hypothetically the Marriott Vacation Club went out of business, what would you own? You would own a piece of paper that has no, use or intrinsic value thereafter, right? Your asset's effectively gone, right? Because it's all predicated on the whole Marriott Vacation Club ecosystem. Contrast that to Pacaso. If Pacaso were to go out of business, you own a house, and the operating agreement was set up in such a way that it actually contemplates that. So if Pacaso were to go out of business, you and your other co-owners would simply find another property manager or vote, which is also outlined in the operating agreement, to sell the whole home and get out of it completely. So they're just completely different types of, products. One is an alternative way to stay in a hotel. The other is an alternative way to own a vacation home.
Are there seasonality issues associated with pricing? Because when I think about a market like Lake Tahoe, right? Like if there's a Wayne Newton show going on, like that part of the season should theoretically be more expensive. And the ski season maybe is more expensive. Maybe the spring is less expensive. Do your eighths entitle you to go a specific time of year? How does that work if everybody wants to go skiing or everybody is just a big Wayne Newton fan? How would that work if 8 people are sharing the house in Tahoe?
Yeah. So one of the many things that we've built to make this whole co-ownership process possible is a proprietary scheduling tool. We call the tool Smart Stay, and it's available in an owner's app that every Pacaso owner gets access to. And what Smart Stay does is it distributes the calendar throughout the year such that each owner gets their pro rata time of each of the seasons. So if you own 1/8 of a home in Lake Tahoe, Smart Stay will ensure that you get 1/8 of the peak season, 1/8 of the non-peak season, and 1/8 of the holidays. It also contemplates this concept of what we call special dates, but you can think about special dates as holidays. And special dates also take into account locally relevant holidays. Like, where I live in Napa Valley. And in Napa Valley, we have a big music festival every year called Bottle Rock. It's like the Coachella of Napa Valley. Bottle Rock, even though that's not a holiday. Yeah, it's a lot of fun. Bottle Rock, even though that's not a holiday for other markets, it certainly is a special date in Napa Valley. Smart Stay contemplates that. So the algorithm's designed such that there is a 2-year forward-looking window that people can reserve time in, but their allocations are limited to 6 stays per 1/8. So if you do the math on that, 6 times 8 is 48 weeks. So in a total of 104 weeks that are available to book, the maximum number of weeks that could ever be booked at any given point in time is 48. So the calendar is always more than 50% available. And that is true of the holidays as well. So what that means is that if you really want that, Bottle Rock weekend, and it is a hot date in that particular market, you may have to reserve it way out in advance. You may have to reserve it 18 months from now. And the cost of reserving something 18 months from now is you're not going to be able to book any other holidays between now and then. So it really puts the owners in control and gives them the ability to choose. Do I want certainty around particular dates that are in high demand? If so, there's a cost associated with that. Or would I rather retain some flexibility and get more holidays throughout the year? And the owner has control over that decision. So the way that most people describe the scheduling once they've become a Pacaso owner is if you own 1/8, you're going to feel like you get about 80% of the dates that you want. You're definitely not going to feel like you get 100% of the dates that you want because you don't own 100% of the home. But if you want to feel like you're getting near 100% of the dates that you want, the solution to that problem is buying a quarter share. And the reason why the quarter share is such a game changer is because it enables you to have double the spending power in the Smart Stay algorithm. So you can afford to reserve Bottle Rock 24 months in advance because you have an extra holiday reservation, and 1/8 owners aren't going to be able to do that.
I think, I mean, for any second homeowner out there, it's most cases you get 10% of the use for a normal second home with 100% of the worry. And in your case, you can get 10, 20, a quarter of the use with zero of the worry of the management. And
much less cost too, right?
yep,
I mean, these are, most of our homes are, say, I mean, the range is like $2 to $20 million in terms of home price, but the sweet spot is like $4 to $6 million, which is a lot of money, for a home, especially a second home. When you break that into eights and you're talking about a $600,000 share, and we provide financing, by the way. So on a $600,000 share, you'd need to put 30% down. So call it 200 grand ish. 200 grand down on a $4 million home is a lot more attractive than what it would cost to buy the whole home.
I think that's crucial not only for yourself, your team, your VC investors, or your now Reg A investors, is the verticalization that you provide, not only from facilitating the transaction, but like Zach said, the management of it and maintaining the harmony among co-owners, crucial. I'm not going to ask you about how Pacaso relates to housing affordability because, what you're essentially doing is carpooling for second homes and, whoever can see it, then maybe one day they will. But, you're guaranteeing higher use of the property. So that means you're generating more local economic activity. So talk about how Pacaso impacts the communities where you operate, and how many do you operate now in?
Yeah, so we're in about 40 communities now, mostly in the US, but we also have Paris, London, and Cabo, with big plans to continue expanding throughout 2025 and beyond. The community impact is a really important topic. And frankly, co-ownership is part of the housing affordability solution, believe it or not. I mean, you alluded to it in your remarks with the carpooling analogy, but one of the main challenges in second home communities is the fact that there are so many second homes in the community. And the reason why that presents a challenge is because most second homes are empty 10 to 11 months per year. And when you have an empty home or, thousands of empty homes in these communities where we operate, that means that during the shoulder seasons, like right now in Lake Tahoe, as an example, I can attest to this, the businesses don't have people, shopping at their stores or visiting the restaurant or buying food in the market. So it's really hard as a local business owner to be able to survive in the shoulder seasons. And there's all kinds of downstream consequences associated with that. When a business owner struggles to survive, it means they struggle to keep people employed, to pay competitive wages, to people can't even afford to live in these markets anymore, which leads me to the next challenge with empty second homes. Every second home that's sitting empty in a market is a home that could have been occupied by a primary homeowner. One of the biggest issues, like real estate related issues in all these second home communities, is the fact that locals can no longer afford to live. Like in a market like Lake Tahoe, people are driving in from Reno, which is a 45 to 60-minute drive without snow. Could be hours with snow, which just isn't a great or practical way to live, right? So back to your carpooling analogy, what Pacaso does is it consolidates demand into fewer properties. So instead of having 8 people buying median priced homes in a second home market, we're pulling them together in a group, moving them up market into a very luxury home, and freeing up more opportunity at the median price point by moving demand away from that tier. So co-ownership, but by no means is it going to solve the housing affordability problem. I mean, the housing affordability problem is kind of here to stay, unfortunately. But the only 2 things that we can do to mitigate the pain associated with the housing affordability problem are either build more houses or make better use of the homes that we've got. Because the only reason we have a housing affordability problem is because we don't have enough supply to meet the needs of the demand. It's that simple. And co-ownership fits into the second bucket of making better use of all these empty second homes that are just sitting there for 10 to 11 months per year.
I think, putting the two in the same conversation, and we on Tangent here love to talk about housing affordability as much as the next person, but you're not the one deciding how many homes and how many get built in every market. But I'm curious to ask you can you walk us through a little bit more about your business, the primary revenue streams, and also how is it appealing for potential Reg A investors? And also want to ask you, do Reg A investors, are they also part owners of the homes themselves or just Pacaso, the business?
So there are certainly Reg A investors that also own Pacaso shares. And in that case, if you've purchased a Pacaso, there's a pretty good chance you're also kind of bullish on the company. And as I mentioned before, that's kind of part of how we came up with the idea for Reg A. A lot of our customers were asking if they could invest. So yes, lots of our Pacaso owners are also Reg A investors. But you do not have to be a Pacaso owner to be a Reg A investor. We also have, and that's one of the real beauties of this Reg A offering, this company that would have previously only been available to institutional investors is now available for any retail investor. And it's super easy. You can go to our website, pacaso.com, and there's an invest button on the top right-hand side of the screen where you can invest as little as $1,000. And it's like a 5-minute exercise. It's a pretty streamlined process. In terms of the business model, before I get into the business model, I'll just talk about how I think about the long-term opportunity for a second. So I think Pacaso sits somewhere between, like if there were a Venn diagram on the screen and there were two big circles, one circle being travel, with travel being hotels and Airbnbs. Yeah, I love the visual there. The other circle being real estate, like traditional real estate, buying a whole home. In the middle of that Venn diagram where they intersect is where Pacaso lives. We live somewhere between owning a whole home and somewhere between traveling to a vacation market. The product, in essence, gives you most of the benefits of ownership and the benefits of having a vacation home that you can travel to. So as I think about the size of that opportunity, I think about how many people aspire to own a vacation home. That's like the first question. The second question is, how many of them would prefer to own this way when compared to the alternative of owning 100% of something that they're only going to use 10% of the time? We've done a bunch of survey work on this question and found that about 75, and our survey work is limited to America, so I can't extrapolate, the global opportunity, which is much larger. But in the United States, about 75% of Americans with discretionary income aspire to own a second home. So after food and primary shelter, this is an aspiration that a lot of people have. And if you just look at the market that we're serving today, which is a high net worth family that's interested in owning a luxury home, we estimate that there's more than 3 million of those households in the US alone. 3 million households with a household net worth of 5 million or above. And that is just our initial opportunity. Long term, we plan to be available in more markets at lower price points to serve a much bigger audience, to the tune of more than 100 million families around the globe. And that's a strategy, this starting at the high end and working down market is a strategy that lots of companies before us have employed. Uber did it with Uber Black before they went to X and Pool. Tesla did it with a Roadster that was over $200,000 in today's dollars, 15 years ago, before they went to the Model S and then the X and then eventually the 3 that was available to a much larger audience. So we're still selling Roadsters today, which are $4 to $6 million homes in places like Paris, London, Aspen, Napa. But long term, we plan to serve a bigger audience. In terms of our business model, it's a really cool and interesting business model in the sense that we have multiple revenue streams that are quite durable and recurring in nature in the case of most of them. So the first way that we make money, you could call this kind of the first revenue stream, is a service fee that is effectively a markup on the real estate. So if we take a $4 million home, we furnish that home, and then we apply a markup of around 15%. And that is our service fee that we make on the front end. Once the home is in our ecosystem, it stays in the Pacaso marketplace indefinitely. So all these other services that we're providing, from property management to furnishing and designing the homes to all the financing that happens, the 70% of people who buy a Pacaso use financing. We provide that financing all the way through to the resale transactions. So we've created the first of its kind resale marketplace so that when somebody buys a Pacaso share, the whole home doesn't have to sell for them to get out. They just sell their individual share, and we make a standard listing commission on that as well. So that's our business model in a nutshell. And, we think there's an opportunity to build a really, really, big and exciting and durable business over the long term here.
Yeah, I think it's fascinating how many different but still focused and that work in harmony between each other revenue streams you have at this early stage. And I think that's shows not only the strength but the potential in the long-term viability of the model. And talking more macro, I think absolutely in terms of the potential demand worldwide. I mean, with the strength of the dollar and people desiring ever more to spend time abroad, I think there's tremendous potential in international growth.
This episode is brought to you in collaboration with Blueprint, the future of real estate. A few weeks ago, in September, Jeff and I participated in the largest, most global gathering of industry leaders and innovators leading the charge in changing the built environment, from construction to transaction, for 3 days of networking, learning, and ecosystem advancement in Las Vegas. With trillions of dollars of assets and the best global innovators under one roof, the future of the built world happens at Blueprint. Blueprint 2025 will take place at the Venetian Las Vegas from September 16th to 18th. Learn more and join the interest list at blueprintvegas.com. That's blueprintvegas.com. See y'all there.
Something that I humbly may predict, I mean, you said that the idea for Reg A investments came from already Pacaso owners. And I think it could become the other way around in the future, where the investors started as Reg A and then they became homeowners of a Pacaso.
We're actually already seeing that. I mean, we hoped that that would be the case, but honestly, we kind of thought about it as icing on the cake, meaning we're primarily interested in Reg A because it gave us the ability to kind of democratize access to our business. And we felt like the awareness and this just having a larger audience of people who believe in the business, that are talking about the business, would be good for us over the long run. But the other thing that we're already starting to see is exactly what you just described. I mean, it turns out that people who are intrigued about Pacaso enough to invest also start to poke around on our website and see homes that they're interested in. And then some portion of them make it into our sales funnel and end up buying. So that is definitely a double benefit. I kind of think of it as like one of the main benefits, at least in my opinion, at least for a consumer facing company like us, when you go public. Like when you go public traditionally, one of the big advantages is it's a big event. It's a big awareness event. Now you've got thousands of people who are hearing about the business and following the business, and it just helps to establish the brand. And Reg A basically provides that same benefit, but you don't have to be public. You don't have to be traded on an exchange. There are, by the way, I should have mentioned this before, Reg A is very similar to going public in the seriousness of it. I mean, all of our information is publicly available to all of our investors. You can find it on our website. You can see our audited financials. We report on earnings twice a year. So the SEC basically, by making private investments available to the public like this, the SEC wants to be sure that consumers are protected and that consumers have access to all the information transparently. So that some companies might look at that as a downside because there is a cost and a lift associated with complying. But we believe in transparency as part of who we are. And we were already running our business like a quasi-public company. So the lift wasn't that big for us. But that is an important detail associated with Reg A that makes it work.
Can I ask a question on that?
Sure.
Because I was curious about the marketing, because when the marketing of that, when you say that there's been 100 million of gross profit,
yep,
it's like, okay, well, cumulatively it was 100 million in gross profit, but then it's not net profit, right? You're still running a startup. One, are you finding that people like Zach and I are professional venture capitalists? So if we were looking at the deal, and we're obviously doing things in Reg D, we're tearing the whole thing apart. We're looking at every single line item. Are you finding that people are saying, hey, Austin, this is really interesting. Can we dig into the numbers? Or is that not a thing with Reg A? And it's just like, hey, they're looking at this and they're saying, this is a really cool concept. This is the future of how people are going to own fractional property, which it very well could be. Whether or not Pacaso is successful as a going business concern, the way you guys have set it up, I think is very intelligent. Are the Reg A investors looking at that with any kind of granularity, or is it more like, yeah, they want to have exposure to something that's really cool? Like, how do you think about that?
I would say it's a mix of both. So a lot of the Reg A investments are smaller. Like as I mentioned, you can invest as little as $1,000. The averages typically are higher than that. For most people, I would say that are investing, less than $10,000, they're probably not, doing the level of investigation and analysis on the financials as a larger institutional investor might, that's writing a $50 million check. But there's also there's no limit on what you can invest in Reg A up to the 75 million. So I have to believe that the people that are writing big checks, several $100,000 investments, I have to believe that those people are looking at the numbers. But all the numbers are out there. I mean, that's the main thing. Like, as you guys know, as venture capitalists, like, you put together the diligence list and the company gives you all the information that they have. But a lot of the companies that you're looking at, especially Series A, Series B, aren't at the level of, scale and sophistication as what we're obligated to be at to be compliant with Reg A. I mean, we have,
Right.
Big Four auditor, all of our information's out there. And we talk about, both cumulative numbers and all of our period numbers are available as well. Like, we just reported our first half. We generated just under 88 million in top line gross real estate transactions, and then 13.2 million of adjusted gross profit. And the adjusted gross profit is basically the amount that we keep. It's our markup and the other services that we're providing to maintain and operate the home.
Before corporate expenses, obviously.
Exactly. Yeah. Whereas the top line revenue, includes the value of the real estate. So the real estate is, you could think about like a cog to get to our adjusted gross profit. You can also see our burn. So we reduced our burn significantly in the first half, down to 10 million, negative 10 million, which was a 40% improvement over the prior period. And one of the things that could cause some early stage companies to be, uncomfortable under Reg A is the fact that you have to disclose all this. Like, venture capitalists understand that high growth, big TAM category creating businesses like us burn money for several years. Like, that's the playbook, right? You're investing ahead of revenues to create the category and get to scale. And some companies may not be comfortable, disclosing that through Reg A filings, but it's part of the deal. You can't hide behind anything in Reg A.
So curious. Suppose we should revisit this in a year. So let's assume the Reg A offering is really successful. What I'm trying to tabulate in my head is the trade-off for a startup company to go the route you're going versus doing a process with venture capitalists, which is typically going to be a much tighter timetable, right? Like, most folks are not leaving a round open for a year.
Right.
The signaling of that is not great in our industry, but for the Reg A, it's a totally different ballgame. Also, because of the way that you can advertise it, like the whole thing is different. And I'm curious about your opinion, and I'd love to hear Zach's also. When we look at this a year from now, and if you guys are able to raise all this money, or venture capital firms going to be at risk? Like, do you think startups will make this a regular occurrence, or do you think, to the point you made earlier, that they're going to say, hey, there's a lot the kimono has to come completely open. It ain't worth it at this point. Like, I'm very curious what you think about that.
Yeah. So this is purely my opinion.
Of course.
So I think it depends on the stage of the startup. I think Reg A is really ideal for companies that are of a scale that they can kind of withstand, the investment and the compliance requirements that come with Regulation A. Like, when you're an early stage startup and you don't have a, big finance and legal team and big budgets to execute a marketing campaign and all the stuff that's required for a Reg A to work, I don't think it would be a great option for an early stage startup. I think the venture capital path is great for early stage startups because, they can make decisions quickly, and the bar of what you have to invest and comply with is much lower. But in our case, like, we did 3 venture backed rounds. I mean, we did series A, B, and C that were all venture backed by, super credible firms. And we weren't in a big rush, to do the company has runway. It's not like we had to do a round really quickly. So we had the luxury of exploring Reg A, and we were attracted by the features and benefits of Reg A when compared to the alternative for this particular moment in time. But like, if I rewind back to when we did our Series A or Series B, maybe even Series C, I probably wouldn't have chosen Reg A. It was just like when we did our Series A, it was a group of investors that believed in my co-founder and I. I mean, it was 2 guys and a business plan on a piece of paper. We had no product, no revenue, no customers. There wasn't much to talk about in a Reg A offering. So it was a venture capitalist that believed in us, that made a bet. So I think that's the right solution for an early stage company.
And for Reg A, are Reg A investors allowed to trade? Is there, can they trade amongst themselves, or is it locked up until, because that I actually just don't know. I'm not familiar with it.
I mean, for the most part, you're illiquid until there is a liquidity event. I mean, they could sell, John Doe wants to sell to his cousin.
If you own a Pacaso property, if you're a 1/8 owner, you mentioned the secondary sales. Is a 1/8 owner allowed to say, hey, I want to put my 1/8 for sale? Is that allowed?
Oh, yeah, absolutely.
That's
Yeah.
super cool. So it's like,
Yeah.
So if you want exposure to without the platform, you can buy the property. If you want exposure to the platform without the property, you can go this Reg A route. That's really interesting.
What is undisputable from Reg A is that, such as Pacaso, is that it really levels up the transparency and the accountability.
Totally.
But this also, significantly changes that dynamic of the financial and the startup and the, traditional, if you will, investor storytelling. Curious, Jeff and Zach, how do you guys think about that perspective? Like, in terms of having to adjust your storytelling to, what now is required to disclose and like maintain twice a year. But how does that, from the investor perspective, that sometimes you rather keep some stuff more under wraps, or I guess sharing less information to be able to shape the story long term?
That's not the hesitation. Like, I've seen a bunch of deals on WeFunder and whatnot. And now, again, I'm going to caveat this, because what Austin is conveying is very different than what I have seen, which is they're conveying, hey, we have the auditor. We're issuing financial updates twice a year. Like, they sound like they're doing it the right way, the way that established entrepreneurs like Austin and his co-founder are doing it. What I have seen is the opposite of that, where there's zero transparency. I mean, I used to be a prolific angel investor, not quite like angel genius Zach Aaron's, plug right there. By the way, I don't know where he's gone, but he's not here, and we can just say anything we want about him. But one of these companies went the Reg A route, and they just lied, like totally lied. Again, this is one example. It was through the WeFunder platform, not assigning blame to WeFunder, whatever. But on the other side is like, what an interesting way to test the public market before going public, because that's essentially what you guys are doing.
Exactly.
When you decide, like, yeah, we're going to go public, well, we've already had to do all of this compliance for this one offering. I have to think further about this. I'm curious, Austin, do you guys think after going Reg A, like, let's say you said, yeah, we're going to do a really big venture round because we're going to acquire somebody, let's say, has copied your model in Europe and you want to buy it. Would you potentially do another venture round after that? Because raising Reg A is, like, if that's a year, that's strips and drabs. Whereas your previous venture rounds were probably large, 20, 30, $50 million checks from venture firms. I'm super curious how you think about that.
Yeah, so we could certainly raise from institutionals again, just like public companies do, right? Like, public companies put together, deals with institutions all the time when they need a big slug of capital for M&A or, to refinance debt or whatever the case might be. So that option is certainly available to us as well. But back to your kind of the WeFunder example that you shared, I think most of the companies on these crowdfunding platforms are operating under Reg CF, which is a much different thing. Reg CF is much, much lighter weight, but
that's right.
That's the difference, right? You can kind of, and I'm not an expert on Reg CF, but my understanding of it is that the requirements are very lightweight when compared to Reg A. Reg A is almost like going public. We had to file a form called a 1A, which closely parallels the S1. When material things happen in the business, we have to provide, updates to those in the same way that a public company would. The main difference is that we report twice a year instead of 4 times a year. That's kind of the main practical difference that I noticed. But the lift is pretty similar. I mean, Reg A is no joke. And one of the things about Reg A from a compliance and disclosure requirement, but one of the things about Reg A that I found to be so interesting is so few people know about it. I've been a tech entrepreneur for 20 years. I hadn't heard of this thing. I'm friends with a bunch of great, and prominent investors who hadn't heard of this thing. They obviously knew about Reg D, they knew about crowdfunding, and it's such an undiscovered, vehicle. And I think it's when you look at the numbers, and this would be an interesting thing that, to follow up on at some point. But I remember looking at the numbers when we were doing our diligence on this before we decided to do it. And the amount of money that's being raised under Reg A is growing dramatically every single year. And I think as more and more companies that consumers know, like us, leverage it as a channel, I think it's going to continue to grow in popularity. And I think it's quite possible that at some point, many growth stage firms like us consider this over the alternative of raising from institutions. Because again, not for everyone, but for a company that benefits from growing the audience, and benefits from the synergy of someone that's investing in the company might also be interested in buying our product. That is valuable, right? No offense.
Yeah, that's super interesting.
No offense to the VCs, but when you raise money from a VC, you get one guy on your board or one guy, in your Rolodex that you can go call. But when you raise from Reg A, you get hundreds of thousands of people that learn about your brand and tens of thousands of people that become investors in the company.
But the flip side is those tens of thousands of people are going to be like, Austin, my plumbing's leaking. You're like, that's not actually that is a problem.
Yeah, it's not free, right? It's not free. We talked about the disclosure and compliance. The other costs associated with Reg A for companies is there's a marketing expense. You have to generate awareness of the offering, but we don't view that as a sunk cost because that's money we would have spent generating brand awareness anyway. So it's kind of like knocking out 2 birds with 1 stone. And then there is a couple extra people that you need in the organization to support it. There's an investor relations function, for example, that we didn't have to have before. Now we have to have an investor relations team that fields phone calls from investors when they have questions. So there are some costs associated with it. And that's another reason why I don't think it's really a great path for super early stage startups.
We're not confirming nor denying here that Jeff has used one of their founders in the past for plumbing reasons in their homes. But is Jeff a closeted Reg A investor or not? Tune in. We will find out.
That's right.
I think what Pacaso is doing at the end of the day here, is tapping into their community and becoming a truly community-based business in the sense that you heard your community, the owners are asking to be part of it, and then more people are seeing believing in the model. And I think, if you listen to your community, not too many bad things can happen, I guess. Austin, collaboration superpower. If you could choose one person, historic or living, to do a partnership with, who would it be?
Steve Jobs. Just kind of a Steve Jobs fan, for all the obvious reasons. He just, in my mind, he was just such an icon. I never had a chance to meet him, but that would have been cool.
Sounds awesome. Jeff, is yours still Elon Musk? You want to make it a little more generic or less generic?
I'm going to keep it Musk.
For the next 4 years at least. Anyway, Austin, where can Tangent listeners learn more about Pacaso and connect with you?
Definitely check out our website and our social channels. So the website is pacaso.com, pacaso.com. For anyone interested in joining the ride, the investment growth ride that we talked about, there's an invest button on the top right-hand side of the screen. Everything you would want to know is available there. And then we're also available on kind of all the social platforms at Pacaso Homes. And if you're interested in just checking out, fun real estate, whether you're serious about buying or not, doesn't matter. I'd encourage everyone to download the app. It's a fun and productive way to kind of kill time on the weekends. We've got a lot of really amazing properties that you can browse through all over the world.
And last but not least, Austin's co-founder was mentioned a couple of times without name, but so just shout out to the magnificent Spencer Rascoff, your co-founder and also co-founder and former CEO of Zillow. Austin, thank you so much again for coming to Tangent today and sharing your vision, your business, and your wisdom with us.
Thank you, guys. I really appreciate the opportunity.
If you like what you heard, please subscribe, rate, and review Tangent, and share the show with a friend. This episode is produced by me, Edward Cohen. Thanks for listening to Tangent PropTech, and remember, collaboration is our superpower. So stay curious and always be learning.